Hello, and welcome back to Principles of Macroeconomics. I'm your host, Dr. B, and today we are going to be talking about the trade off between inflation and unemployment in both the short run and in the long run. Before I begin today's lecture, I would like to highlight where we are in the class today. We are in the final lecture. We are in week 15. Week 15, this is the last week of class. This video is being pre-recorded because today, Monday, I will be traveling and wanted to give you some extra time to focus on the remaining homework assignments that you have left and the completion of the homework assignments for this week as well. Why you may ask I'm doing that is because next week you will have your final exam. The final exam will cover week 9, chapter 12, through week 15, chapter 23. There are 20 questions on the final exam, mix of true, false, multiple choice. The final exam is worth 20% of your total grade. My recommendation is to start it early, work often, save your work, come back to it. It is open and available now if you'd like to work ahead. My recommendation is to review the PowerPoint presentations, video lectures, as well as your textbook. It is open book, open note, open whatever you prefer, and I'm sure that you'll do very well on the final exam. So that's why we're doing this pre-recorded video. So let's go ahead and jump into today's lecture. So we're going to be talking about the relationship between inflation and unemployment. We'll talk about how they are related in the short term and the long term, what factors impact this relationship, how do we reduce inflation, and what were some history lessons from inflation. As you recall, the idea of inflation is when the price of pretty much everything rises, and it's a result of too much government spending. Unemployment, as you know, is when individuals in the labor market are not working as a result of being unable to find work. These individuals are willing and able to work, but unable to find work for various reasons, such as minimum wage, unions, wage efficiencies in the process of searching for a job. There are a couple of economists I'd like you to become familiar with. One is by the name of A.W. Phillips. And Dr. Phillips was one of the founding economists to find a relationship between inflation and unemployment. And Dr. Phillips identified that when inflation levels are high, unemployment rates are low. High unemployment, low inflation. Low unemployment, high inflation. That is the relationship between the two. And Dr. Phillips identified this relationship and what occurs with inflation in the short run. Dr. Phillips identified this correlation where inflation rates would go up when unemployment is low for a short amount of time. And at a certain point in time, unemployment would return to its natural level. And inflation would still either be high or go down a little bit. The idea here is that with nominal wage growth, there was a negative correlation with unemployment in the United Kingdom, in the UK. In 1960 two additional economists came along and identified a negative correlation between the United States inflation and unemployment. And these two economists named this concept the Phillips Curve because we were able to graphically identify the relationship between inflation and unemployment in the short term and in the long term. The graph represents two possible outcomes when there is a changes in price. When there's a small change in price, demand is typically low and inflation is typically low with low output and high unemployment. This makes sense because it relates to what we talked about before in previous chapters. With higher prices, there's going to be less consumption. Typically, with higher prices, there's going to be higher unemployment and low inflation. The opposite is also true. When demand is high and there's somewhat of a higher price, there's going to be higher inflation with high output and low unemployment. Currently in the United States in 2021, we're seeing what's happening with that. We're experiencing letter B currently. We can see the correlation graphically with respect to inflation and unemployment. We can see that with low demand, there's low inflation and high unemployment. With high demand, high inflation, there's low unemployment. Since fiscal and monetary policy have impacts on demand, which we talked about last week, we can see that the Phillips curve offers opportunities to Congress. Congress and the Federal Reserve enact fiscal and monetary policies in order to influence inflation. And they have a few choices along the way. When there's times of low unemployment and high inflation, they have the ability to change that. When there's times of low inflation and high unemployment, they have the ability to change that. And of course, they can select anything in between. Currently in the United States, 2021, we currently have low unemployment and high inflation. Now, of course, the inflation may have been caused by a couple of shocks that we'll talk about. Namely, the pandemic caused a significant shock to our supply chain. And we also have low unemployment. A lot of people are working currently, which is also leading to higher prices. We'll talk about how that happens. Ideally, in the United States, we aim for about 2% inflation rate year over year, which is also correlated with some unemployment, but not at high rates. So anything in between is really ideal. And there's some data to support this concept of the Phillips curve that makes the Phillips curve reliable and stable. In the 1960s, there was an experience to reduce unemployment. But this, of course, led to higher inflation. Low unemployment, there's going to be higher inflation. Low unemployment, meaning a lot of people working, there will be higher inflation. When less people are working, there will be lower inflation. So it's an inverse relationship. That's, of course, in the short term. In the short term, higher inflation, lower unemployment. Also in the short term, if there's lower inflation, there's higher unemployment. That, of course, was until 1968 with two very well-known economists. Milton Friedman and Edmund Phelps. These two economists came along and said that the trade off ultimately between unemployment and inflation is temporary. And it's based off the concept of, in the long run, unemployment will return to what we call its natural state. There is a natural state of unemployment. That natural state is typically driven by the participation levels in the economy. So, graphically, using the Phillips curve, we can see on the left, we have a natural rate of output. That's the production levels in the economy. On the right, we have a natural rate of unemployment. And what happens when prices increase? There's a greater output. But also, what happens when there's higher inflation? There's higher prices. So we can see the correlation here, right? We see that with higher prices, there's higher inflation with greater output. Sounds good, but in the long term, it's not so great because with higher prices, it makes it more difficult to afford things. The Phillips curve is downward sloping and to the right. And the Phillips curve tells us that in the short run, the correlation between unemployment and inflation is that with higher inflation, there's lower unemployment. That's true to a degree in the short term. In the long term, unemployment will return to its natural levels. Unemployment will return to its natural levels, and inflation will either remain high or ultimately decrease to some degree. And that's what I would fully expect to happen in 2022, in my opinion. So, the economists, Phelps and Friedman uh, and Phillips, ultimately looked at this concept called expected inflation. And that's how much we would expect price levels to change over time. As I had earlier said, here in the United States, a good level of inflation is about 2% per year. So, this concept resulted in a very good formula because it allows us to kind of predict to some degree what a good level of inflation would be. It's based off of the unemployment rate through the Phillips curve equation. The Phillips curve equation is unemployment rate should be equal to the natural rate of unemployment minus the actual inflation minus the expected inflation. Now, please, as you're calculating this for your homework assignments, for a homework problem that you may encounter, remember the laws of mathematics. Please complete what is in the parentheses first. So actual inflation minus the expected inflation, do that first. Okay? So that'll be natural rate of unemployment minus parentheses actual inflation minus expected inflation. And what this equation tells us is the short term and the long term. In the short run, the Federal Reserve can, of course, reduce unemployment rates below the natural rate by increasing inflation greater than what is expected. Sound familiar? In the long run, unemployment rate will return to its natural rate, regardless of what happens with inflation over time. We can see this graphically. Initially, the expected and actual inflation rate is 3%. in this example. The unemployment natural rate is 6%. If the Federal Reserve decides to increase inflation by 2% by pumping some more money into the system through government spending, the unemployment rate will fall to 4%. Now, of course, with that, we would expect prices to rise. In the long run, the expected inflation increases to 5%, which will shift the Phillips curve upward, and unemployment will return to its natural rate of 6%. It's typically what happens. In the early 1970s, there was greater unemployment, and there was also higher inflation. The explanation of this phenomenon was that expectations were catching up with reality. Now, of course, there are other factors that influence the Phillips curve, such as supply shocks. Most recently, there was a supply shock caused by a pandemic. And the pandemic led to higher expenses for the companies and higher prices for the consumers. With this, there was a shift in the aggregate supply curve and in the Phillips curve. The example I'm going to show you is a little bit older. It's from an increase in oil prices. And graphically, we can see these shifts. Inflation and unemployment rates both increased as the Phillips curve shifted upward. In this example, we can see oil prices increasing year over year from 1973 to 1981. There were other things happening at the time, but there was a supply shock to the oil reserves. The United States was running out of oil at that time. There was an oil embargo. There was a couple of situations with OPEC and, history, right? As a result of that, these higher prices of oil, there was higher inflation, which caused the Phillips curve shift. Oil prices worsened this, and the Federal Reserve tried to rectify this situation, which ultimately backfired. So the shock actually worsened inflation over time. Now, the Federal Reserve typically tries their best to counteract situations of inflation. To reduce inflation rates, we call this disinflation. And to reduce inflation, the Federal Reserve slows rates of money growth, which reduces aggregate demand. How does the Federal Reserve do that? They spend less money over time. So with this new $1 trillion infrastructure bill that Congress recently passed and is now law, we currently have high inflation already. If Congress spends this new money too quickly, the inflation will worsen. So my recommendation to Congress is to spend it a little slower to help to reduce the inflation rate. In the short run, Output decreases and unemployment rises when the Federal Reserve tries to reduce inflation. We know that because of the Phillips Curve correlation. When inflation is high, unemployment is low. When inflation goes down, unemployment increases. Right? It's an inverse relationship. In the long run, however, we know, thanks to Friedman, that unemployment will ultimately return to their natural rates. So will output. Output meaning gross domestic product production in the United States. As the Federal Reserve examines monetary policy, and to some degree other policies, we would expect shifts in the curve, in the Phillips curve. Over time, inflation falls and the Phillips curve shifts downward. In the long run, there will be a return to the natural rate of unemployment with lower inflation. We can examine the reduction of inflation through cost. What happens to the cost? Because as you know, when there is higher inflation, there is lower unemployment, which is good because it means the vast majority of Americans are working. But it's also bad because of higher prices of everything. How does the government fix that? Well, they spend less, inflation comes down, but what happens when inflation comes down is unemployment rate rises. Okay, not as good. So the Federal Reserve tries to adjust. And with this adjustment, it ultimately costs something. There must be a sacrifice. And this creates what we call a sacrifice ratio. For every reduction in inflation, there is a sacrifice. And that sacrifice is economic output, the gross domestic product per year. To reduce inflation by 1%, gross domestic product must be sacrificed by 5%. This can be spread over time to limit this sacrifice. But yet still, there will be a sacrifice to gross domestic product. So, of course, there's some rationale behind this. People optimally use information that they have to influence government policy decision making. When forecasting into the future, it is always difficult to tell what will happen next. My expectation with 2022 is that inflation will ultimately come down a little bit and the unemployment rate will rise a little bit. And ultimately, the unemployment rate will return to its natural state. Inflation, on the other hand, is still hard to tell. My guess is it will still remain high because the government is still spending money. If the Federal Reserve is able to convince Congress that it's committed to reducing inflation, we would expect that inflation will calm down in the short run and the Phillips curve will shift downward. But of course, this also means that unemployment will rise to some degree. And the output will fall to some degree as well. There's another wonderful economist and Fed chairman that I'd like you to know, Paul Volcker. Paul Volcker was appointed in the late 70s at a time during high inflation and high unemployment. And Paul Volcker did his best to change the Federal Reserve policy to disinflation. The idea here was we need to get inflation down because people are spending too much money on everything, especially oil at the time. So from 1981 to 1984, the policy was focused on job growth to reduce inflation. This was relatively successful because at that time, inflation came down from 10% to 4%. Still very costly, and it still cost a few jobs because economic output, of course, went down a little bit. The next Federal Reserve chairman I want to tell you about is Greenspan. During this time period from 1986 to 2001, we experienced several changes as a result of shocks and as a result of normal day-to-day economics. In 1986, oil prices finally came down from their top when the oil embargo was coming to an end. Oil prices fell by 50%, which is good because it led to higher production. Unemployment rate came down 1989 to 1990 because more people were back to work after a period of high prices. But this also caused the inflation rate to rise. Remember the Phillips curve. The Federal Reserve decided to raise interest rates during that time to combat inflation. Sometimes a good policy to enact. This ultimately led to what we call a mild recession. Recession, as you know, is higher unemployment rate, less economic output, and ultimately that's the situation. And throughout the 1990s, unemployment and inflation ultimately fell, which was good. 1990s was a good time. 2001 rolls around. We had shocks to our economy during 2001 as a result of what the events that occurred on 9/11, the terrorist attacks on our country. And these shocks led to a dramatic recession that lasted for about 10 years. To some degree. I mean, it came back. The economy came back for a couple of years, especially during the dot-com era. And policymakers responded by trying to bolster the economy with monetary and fiscal policy during the 2000s, early 2000s. Inflation rates were relatively low. So were the unemployment rates fluctuated during that time. But overall, we can see those pretty much centralized. In the early 2000s, the housing market was doing very well. But as we know, what happened in 2006 is the bottom fell out. There was a lot of mortgage defaults and foreclosures, a lot of losses with financial institutions. And as a result of all of this, there was a sharp decrease in aggregate demand and a very sharp rise in unemployment. The recovery from this financial collapse, 2006 to 2009, was a slow recovery, 2010 to 2015. Probably took even longer than that. But we came out of it. So in conclusion, it's important to remember the Phillips curve. During the short term, the short run, at times of high inflation, there is low unemployment, meaning a lot of people are working. Also, in the short run, when there's times of high unemployment, there's low inflation. In the long run, you need to remember that unemployment will return to its natural rate, regardless of what happens to inflation. And that, my friends, is the trade-off between unemployment and inflation in the short term, and ultimately the long term when it returns to its natural rate. It's also important to note that when shocks occur to the system, such as a pandemic in 2020, the Phillips curve will result in shifts, and there will be a trade-off between inflation and unemployment, which is what we're experiencing today. The Federal Reserve, of course, can reduce the current inflation by enacting monetary and fiscal policies. To do this, it's recommended that the government spends money at a slower rate, and probably they should increase the interest rates. And that's probably what I would do if I were them. If you have any questions, comments, or concerns about the trade-off between inflation and unemployment, please feel free to email me, call me, set up office hours, whatever it takes. I'm here for you 100% of the time. And now I will record the chapter 23 recording. So please watch the next video. Thank you very much for your time today. I appreciate all of you.